All right, so here we go. We're going to be talking about calls versus put options. These are the only two types of options that there are in the stock market, a call option or a put option. I think it's very important that you take the time to actually really study this. They do become confusing, but I'm going to try and make it simple for you and give you examples and slides so that it makes perfect sense. All right, let's get started. So, a long call option is the first strategy that we're going to teach you guys. It is the most basic and simple strategy. A long call option is the option that you buy in expectation that the stock is going to increase in price. The stock is going to go up in price. And the benefits, like we stated before, of purchasing a long call option versus stock is because options use leverage. The amount of money that is invested to purchase the option versus the amount of money that will be invested to purchase a stock is significantly less. And so we appreciate that. Another thing is also when you purchase an option, the most you can lose is the amount that you paid for the option. So you have two benefits. One is that it costs you less, and two is you have a max loss no matter what the stock does. And you have unlimited profit potential theoretically. And when we say unlimited profit potential, that means if a stock goes from $30, $35 in our case, depending, up to $1,000, you can profit or you can benefit from that. Now we know stocks don't move like that, but that's what they mean when they say unlimited profit potential. Now, as we go a little further, I do want to explain a few terms that we have inside of options. So I'm trying to not get too technical for you, but I do want to make sure you understand it and that it makes sense. We have these three terms: at the money, we just call it ATM for short; out the money, OTM for short; and of course, in the money, which is ITM for short. You as the buyer can determine where you want to buy, what strike you want to buy. If you want to buy in the money, at the money, or out the money. ATM, at the money, is where you buy an option and the strike price is as close to the current stock price as possible. So the stock's at $30 and you buy a $30 strike price, that is at the money. OTM is when you buy an option that's above the current stock price. So if the stock's at 30 once again and you buy the $40 strike price, then you are buying an out the money call option. And of course, in the money is when you buy below the current stock price. So if you bought a $20 strike price, then you are buying in the money when we talk about call options. Let me see if I can explain this just a little bit further so hopefully it makes sense. Say you want to purchase a house, right? And the house is worth $100,000. Well, if you purchase that house for $100,000, you are buying an at the money contract, or you're purchasing that house for the value of the actual house. It has no equity built into it. It is worth $100,000. And so if you bought the house and you changed your mind, you say, hey, I want to get rid of this house, and you try to sell it, you could sell it for the $100,000. Now, of course, there would be fees like there is in anything in life, but you would get all of your money back. That is at the money. Now, out the money is when you purchase an option contract, like in this house example. The house is only worth $100,000. You expect the house to increase in value, and so you buy a contract that's worth $120,000, or that's where you get to actually purchase the house at $120,000. So right now, your option contract has no value to it because the house is only worth $100,000. That is what we consider out the money. And then of course we have in the money. So same scenario, the house is still worth $100,000, but your contract is to buy it for $80,000. You have the right to purchase at $80,000, and so you actually have some value built into this house. And so in the stock market, we would think, oh my goodness, I get a house, I'm paying $80,000 for a house that's worth $100,000. Well, that price is already built in. And so one thing I have not said is the price of the option that you buy at the money, in the money, or out the money is valued based off of the underlying, the house itself. So you buy in the money option contract, in our case $80,000, that $20,000 is already baked into the price of the options contract, just as well as the at the money is baked into the price, and then the out the money is cheaper because it has less value currently. So all those things are already baked into the price of the option. All right, the last thing I want to get into before we start getting to the actual call option is what we call the Greeks. Okay, I'm gonna give you two Greeks. There's more, but these are the most simple ones, and they help you understand the option contract. So you have number one, which is called volatility, and volatility really is just the expected price fluctuation of a stock. So if you take a stock like Tesla, Tesla has a lot of movement to it because the CEO is always talking on Twitter, on Instagram, and so that causes the price to move up and down a lot. So Tesla is a $400 stock, and it has an average true range of $20 up or down. So some days it'll move $20, $30. Some days it'll move 10, 15. But when you average it all out, it moves $20 up or down. Whereas AT&T has an average true range of only 52 cents. In the last year, in 2025, the stock has gone from $22 up to $28 and all the way back down to $25. And so it doesn't move that much. And that's why it has a 52-cent average true range. It does not have a lot of volatility because it does not have a big movement at all. So that's all volatility is the expected move of a stock. And now the second Greek is theta. And all theta is just the passing of time. Options were originally created as insurance. And so I always like to refer to insurance when I'm using examples or trying to teach because it makes the most sense. If you purchase a insurance policy for your vehicle and you purchase a policy that's 30 days long or 90 days long, you're going to pay more, obviously, for the 90 day than you would for the 30 day. But because insurance contracts are prorated, every day that you use that policy is going to lose value, even if you don't get in an accident. And so you paid $1,000 for the 90-day policy. And so when you're at day 60, you say, oh, I want to actually cancel this policy. I don't need it anymore. And you go back to the insurance company, you say, hey, I want to cancel this policy. And they say, sure, that was prorated. We're going to give you back $600 because that is the passage of time. So that's all theta is inside of an options contract. Okay, now let's really dive into the mechanics of this option. The stock is currently priced at $30, and we're going to purchase a $30 strike option. And so as the stock moves up in value, we are able to still purchase the stock at $30 and sell it to somebody in the open market at $35, $40, $45, as you will see. And so that is a good scenario for us. So let's just use, for example, that the stock went from $30 to $45. That means that we made $15 on the stock itself, on the option. Well, we have to consider the fact that we spent $300 for this option. And so $1,500 or 15 minus 3 is 12, which we times everything by 100. So that would be $1,500 minus $300. So we actually made $1,200 on this particular option contract. And so, we're excited about it. I mean, $1,200 is a lot of money. But the greedy part of us is upset because we didn't make the full $1,500. And so that makes perfect sense. And I understand it. I've been in that situation time and time again. But let's look at the other scenario. Let's say we purchase the $30 strike option for $300 and the stock goes down in value. The stock goes from $30 down to $15. Well, because we have a contract, we are not obligated to purchase a stock. And so we can just walk away and take the $300 loss. Now, versus the person that actually purchased the stock, they invested $3,000 into buying the stock at $30. And so if they purchased the stock, they would make the full $1,500 as the stock went from $30 to $45. But if the stock drops from $30 down to $15, they would also lose the full $1,500. So for us as option buyers of a contract, our max loss was only $300. And so we had nowhere near the risk that the person who purchased the shares outright had. And so we're not worried about that. And if you really want to make more money or to consider how much more leverage you have, you could actually have purchased 5 option contracts for the same amount of money that the person who purchased the shares invested into the stock market. So you could make 5 times as much for the same amount of risk. Now, granted, if it went down once again from 30 to 15, you would only lose the $1,500. But that's what makes options so powerful and why we love long call options. Now let's talk about put options. Put options are just the complete opposite of a call options. Put options are purchased when you expect the decline in the stock's price. So in life, we're always taught to buy low and sell high. You buy a car for 10,000, you want to sell the car for 15,000. You buy a watch, or I know people who are sneakerheads. So you buy shoes for $100 and you turn around and sell them for $200. Well, put options are the complete opposite of that. Instead of buying low and selling high, we are actually selling high and buying low. You are a contractor and you go out and bid a job. Let's say that you are a plumber and you go out and bid a job to do the plumbing of the newest McDonald's building that's going to get put in your city. And so you bid that job and you get a contract to do the whole building for $10,000. Well, once you have that contract, they are obligated to pay you that $10,000 price. And so now what you're trying to do is you are trying to purchase everything for cheaper. You're trying to get labor for cheaper. You're trying to purchase materials for cheaper. And so if you can actually purchase everything cheaper and effectively do the job for $7,500, that's what your actual expense was, but yet you sold the job for $10,000, now you have a $2,500 profit. That is in essence, the exact same as a put option. You are selling something before you ever bought it. So you sell the house for $100,000, you buy the house for $75,000. You sell the contracting job for $10,000, but you actually only invest $7,500 into labor, materials, and all those things. That is how put options happen. And so as you'll see here on the slide, what you see here is that we actually purchased the $40 strike put. As the price of stock goes down, our option gains value. It takes a minute to wrap your head around that, but we have a guaranteed buyer at 40. And so we are hoping to purchase it ourselves at a cheaper price. So as the stock goes from 40 down to 35 to 30 to 25, our option gains value. And just as previously stated, they say that this has unlimited profit potential. Well, technically it only has profit potential all the way to zero. So the stock or the company goes under, the cheapest you can buy the stock for is zero. If the company goes bankrupt. And so, but realistically, that doesn't happen. And so stocks have a price range. And so we're happy to obviously profit from this, but we don't expect it to go zero. We'd be happy if that happened. But that's not the normal case. And so once again, just like before, our max loss is $300. And so we take the exact same example that we had before. The person that purchased the stocks outright had to outlay $4,000. And if the stock goes up in value, because they're trying to sell it at 40, if the stock goes up in value at 40 to 45 or 50, they are upside down $5, $10. And whereas we're only upside down 300, the most we can lose is 300. And so I don't want to beat a dead horse, but I want you to understand that our max loss is 300, but our profit potential is theoretically all the way to zero.